back to the Trading Room. I'm Shane Vernier, and this is the U.S. Mid-Session Brief. Today, it's No Donation Friday. We're going to talk a little bit about some psychology, how you can end up your trading week with a lot of confidence and momentum. Remember, trading's a marathon. It is not a sprint, and it's all about momentum. If you had a good week this week, fantastic. If you didn't, I'm going to give you some pointers on how to make this week maybe just a prelude to next week, or maybe just a place we can jump off and really close the month with style. I mean, we're already on the 16th day of January. We've only got a couple trading weeks left in the first month of the year. I usually like to spar a little bit. If you guys are boxing fans, I like to spar. I don't necessarily like to come in and shoot for the moon right away when it comes to the markets. I want to definitely get in, test the waters, understand where my ranges are, and then we start adding risk typically as the year goes on. So I'm always a big fan of trading in January. It's a great time to be in the markets. So much going on, a lot of volatility. But by the same token, I'm always thinking about tomorrow. We're always thinking about next month and the next month and what we need to do to really be a good trader throughout the near and intermediate term. So good to see everybody back in the Trading Room. We've just had technical difficulty after technical difficulty today. There are some ongoing outages over at X. Also, some of the Restream services that we use definitely are struggling today to get us up and connected. I don't believe it's a Cloudflare problem. Say that 5 times fast. It's not with Cloudflare. It's with something else. I've been reading online all day that this looks like some sort of probing internet hacking attacks. And that's pretty much what we've seen the last 6 months, more and more of these. So we're going to do our best. Right now I'm showing good connectivity, and I should be up and rolling. We're not dropping too many frames, so it shouldn't freeze on you. Right this minute, though, I am very, very frustrated with the software. Believe me, that's why we were just a little bit late getting started. But we're here, and we're not doing too bad. I feel good today. Ahmed, good to see Ahmed. T. Marina, happy Friday. Hey, T, we're going to go ahead and do No Donation Friday. We haven't done it in a while. If you don't know what that is, be sure to stay tuned. I'm going to give you my playbook and my psychology of how to handle a Friday session and set yourself up for success next week. Ralph H., good to see you over in the How to Trade community. Tuku, Bobby Bob, Ralph H., Andrea Garwal, Lita. Yeah, it's No Donation Friday, Bobby. Absolutely right. Good to see everybody back in the room. We're going to start off with just a key thing that we're going to cover. This is sort of something that's a little bit new. Over at Switch Markets, we've got Switch On, and this is going to be an area where you can go ahead and sign up to receive our weekly newsletter. We had some pretty good reads in there last week. I felt pretty good about it, exactly what we had going. You just enter your email address, and you get signed up for our weekly newsletter. So definitely check that out. I draw that up on every Monday during the U.S. session. You can certainly get involved with probably the live stream is going to give you a little bit of a hint what's in the newsletter, but probably not much. We try to hit the key markets, the key events of the day, and really the idea is to give you some trading ideas, not necessarily trades per se, not signals, but definitely give you a look at what exactly is going on in the market. So something we've been doing the past several months. I'm pretty proud of it. So be sure to check it out, and any feedback at all is much welcome. That comes out. Typically that'll be in your email inbox by that Tuesday UK Open. I draw it up on Monday. I like to watch what happens in the markets Monday, and then we sort of identify what we need to talk about, not only in our analysis video, our Switch On hot picks, but also in the newsletter itself. So if you want to get caught up with the key market drivers of the week and what you need to be aware of and what you need to be thinking about as an active trader, check out the Switch On newsletter. I take a lot of pride there, so be sure to tune in. And like I always say, any and all input is much welcomed. Much welcome. Well, we got to start off with trade updates. Now, a lot of times our trade updates are pretty good. Typically, they're winners. This was a loser. This is one of those that I call, it's a great example of systemic risk. What systemic risk is holding a position in the open market. You have to remember as a trader that every second you're in the market, every minute, every hour, every day that you're holding an open position, you are subject to risk. You're subject to what we call systemic risk. Now, systemic risk essentially, or systematic risk, depends on who you talk to and pretty much where you live. The idea of systemic risk or systematic risk is that the entire market can just fall apart. The market can crumble while you're in a position, and that can lead to you losing money. The thing about systemic risk is that it's typically unpredictable. You don't know when it's coming. It's definitely an unknown. And that's a real challenge for us because as traders, we like to know exactly what we're doing at all times. Today was a fantastic example of systemic risk, really claiming the success of a trade that was looking to be very, very good. And it was one that we went over it yesterday. We always lean into the losses on this live stream. We lean in. We don't run from them. We're not in denial. We don't sit around looking at our credit card bills going, oh, it'll be fine. I'm in denial. I'm $1 million in debt. I'll worry about it later. We don't do that here. We're active traders. We need to know exactly what is going right and wrong with our positions. I always focus on what went wrong and where my stops need to be because that is what we can control in the market. You cannot control how the market moves. You cannot control how far the market goes in any direction. And you damn sure can't make it move in your favor. Believe me, I've sat there in trades with fingers crossed going, please, just this one time. It doesn't work that way. Typically, when it goes against you, it goes against you. And the only thing you can do is get out. Well, today was very interesting. We have a fantastic example of systemic risk sort of claiming the life of our Euro USD trade. Right here, CPI in line with expectations, Euro USD back in play. We had that 62% weekly retracement in play, a level that I really like. 38s and 62s are my favorites. 78's a close third. I ignore 50. I don't even have 23% on my charts. So that's what I look at with Fibonacci retracement, 62%. Beautiful thing. We were looking to step up to the plate and bid right above 116, 116.14. Well, here's our trade. And we were in it. We took some major heat right there. Once this parabolic sort of bottom formed, this is what we call sort of a fish hook sometimes. Nice big move. And then you got that sort of that parabola formation. I became very confident, if not cocky, that we were going to win this one. Goes right back up to break even. We trade positive, trade negative. At this juncture, I still am very confident because we haven't broke 116. 116, the bidders were there. The bidders were there. The bidders were there. This is definitely a swing trade. We were in this for several days. And then right up here, we broke. And I said, well, we're going to win. 116.21. I felt pretty good about that. I said, yeah, we're only a few pips. This thing's just going to accumulate and creep higher, no question. What happens? What happens earlier today? There's nothing on the economic calendar for today. There's no CPI. There's no NFP. There's nothing really even planned. There's no ISM manufacturing, no S&P global PMI. There is no reason for that to happen. There's no reason for this to happen except what? Except for what? I call it Trump risk. Trump decided that he was going to make a few statements today, and they absolutely shook the markets up. Trump tells Hassett he wants to keep him where he is. Warsh Fed chair odds jump. Basically, it's a two-man race for the next Fed chair. That's what they're reporting right now. I don't believe that. I think Trump could pick somebody else just out of the blue. That typically is how he does business. President Donald Trump said he'd prefer to keep National Economic Advisor Council Director Hassett in his position as a top economic advisor, a statement that could change the dynamic of the Fed chair race. After Trump spoke, traders on predictions market raised their bets to a 60% chance of Governor Kevin Warsh getting the job compared to just 16 for Hassett. So here's what we know about Hassett and Warsh. I think it was Warsh, wasn't it? Yeah, Warsh. That's a sort of a strange one, Warsh. In any case, you've got two guys. Both of them are doves. It's just a question of how dovish is the next Fed chair going to be. We knew that Hassett was pretty much going to be a yes man for Trump. He was going to get in there. He's already got a position in the cabinet. He was going to cut interest rates aggressively. Now, Warsh coming out of the blues apparently is probably going to be he's going to be dove. No question about that. But maybe not as dovish or maybe not as ready to take direct orders from the administration. Now, of course, the administration's not going to be giving orders to the Fed chair, but it's going to be tongue-in-cheek, and it's going to be like, hey, we need lower rates, and they're either going to play ball or they're not. Well, we know Jay Powell's not going to play ball. We know that. This Warsh, Hassett, they're both going to cut rates, but Hassett was really viewed as being the dove. So what happened to price action? Very simple. As soon as Trump started talking and he made those comments, that just sent shockwaves through this Euro USD. Right there, that run up right there, 116.27. At that juncture, it could have broke up, it could have broke down, and then the reality started to set in that all of a sudden Hassett wasn't going to be the favorite to win the nomination now. That's big. That's absolutely big. So what happened? Market reverses. USD flexes a little bit. Still, the DXY is nowhere. The dollar index, and it was near flat. But all the strength that the euro had gained over the Euro USD, and it was trench warfare really for about 3 days. There's your rally. Trump speaks. It reverses. We get stopped. I get stopped. I'm out. I have no desire to hold this thing. No way. Not even close. We were up here looking to bang on, grab our 25 pips, and now we get the reversal, and we're coming off in a big, big way. So what happened to that trade? Trump risk. I ran into Trump risk last summer on a gold trade. I still remember it cost me $3,500 in about 20 minutes. I still remember it. So I'm always watching. If you're going to trade and you're going to intraday trade and you're going to scalp and you're going to do those things, you're not going to have as big of risk exposure to things like we saw today. A crazy announcement out of left field. Somebody just says, by the way, I don't think Hassett's the guy anymore. Oh, really? You're just going to drop that on us during trading hours, huh? Thank you. Thank you, sir. So I wasn't really very pleased with that at all. I think without that statement, you probably climb up there and hit our take profit without much trouble. Be that as it may, the statement came in, the market banged. You got a couple of things you can do there. Number one, you can try to ride the turbulence out. You can try to ride it out and give it some room and wait for the market to rebound, which it will eventually, but that's higher risk because if you do get a big breakout, then you're in big, big trouble. The second thing you can do is just cut the trade off immediately. As soon as you see the statement, you see the dome going crazy, you can just exit stage left. There's nothing wrong with either approach. Just be consistent. Take a look at our Euro USD. What's happened here? There was a sell-off. Boom. There was the announcement. Volume spikes. Remember, these are tick volumes. These aren't lot sizes. Boom. Reversal, bang. Then what happens right here? There's a little bit more of a downturn. And then what is that? Compression, 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 and now the trend's on again. I'm more than happy taking that initial loss. I don't care. We had every opportunity to win this trade, and it just didn't fall our way. Unfortunately for us, that's just sort of the way that it is. Couple look at our interest rate expectations, CME FedWatch. Now, here's the thing, 95% chance here on the 28th of January that Jay Powell is going to hold interest rates firm exactly where they're at. And all that's fine and dandy, and that's great. What we want to really know is what about June? Because June's where the rubber hits the road. That's when the new Fed chair is going to step in and take over. Now, Jay Powell, his terms through May, there's some options. He's got some options to stay as a Federal Reserve governor for another 2 years. I doubt that. He's under investigation. My guess is that Jay Powell is going to run from the Fed building. He's going to run into the private sector just like most of them do, or maybe hit a speaking tour or go head on over to Davos or something like that. Hang out. I really don't know what Jay's got planned, but I would be very surprised if he stays on the board of governors after being an acting chair. It just seems to me like staying on as the mayor of the city after you were the president of the country. You don't typically see that happen. So we'll wait and see exactly what develops with Jay, but target rate probabilities for the 17th June meeting, that's the one I'm really targeting on when our rate cuts are going to start coming to fruition. And take a good look at this chart. This is the one that we're going to need to remember. There's about, a 73% chance that we only get a quarter-point rate cut between now and June. If that is the case, the first meeting of the new Fed chair, I'm starting to look for a half-point rate cut. I'm starting to look for a three-quarter-point rate cut, especially if the CPI figures bear that out over the next 6 months. And they're off to just a roaring start here for January. So if you see the data sort of suggests that, okay, if the worst of inflation is over, then you're going to see rate cuts in a big, big way, and I believe that that's probably what's going to happen here. So I'm looking for the next Fed chair on that first meeting in June. The first one, I expect them to come in with style, and if not, then the one right after that. But I expect a series of rate cuts on the second half of this year, probably beginning in June. I expect those rate cuts to be bold, dramatic, and swift. And I think you're cutting to 2% by the end of the year, 2.25%, somewhere right down in here right now the markets are not pricing the probability of that big runner, of that big rate cut mania, and I think we're headed there. I really do. You'll notice the normal distribution skewed to the right, sort of suggesting that interest rates are going to stay where they're at. Boy, I just believe this chart's completely wrong. I really do. I think you're going to see that chart blown out of the water, and it's going to end up being a dovish market driver for the USD and bullish for things like the US 100. So we got a couple questions here. Hello, it's good to see you. What sent the markets dwindling downwards today at the New York Open? That right there. What I just covered. It screwed everything up. When Trump came in and said that, it screwed everything up because the markets were pricing in Hassett as being the next Fed chief. And the idea there was dovish, 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 dovish. So now that we've shaken things up, I'm not saying Trump won't go back to Hassett. He may. And if he does, later in the game, you're going to get a big runner. You'll be looking for, if it's a surprise to the markets, they say, Hassett, you're back in, then you're probably going to see a big jam. I don't put anything past this administration. They have some smart people in there. The Trump people have been in business. It's not like you've got a lifetime bureaucrat in there that doesn't know how the stock markets work and know how the markets work. These people know the markets, and they know when to announce things and when not to announce things, and they know how to influence price action. They really do. I watched Trump do it in his entire first term. He was doing it to airline stocks on the regular. I mean, he was screwing with Boeing in a big, big way. And what we see now is really the same type of thing, but it's more designed to move the markets as a whole. Definitely a crypto market driver in that regard, and commodities as well. Every one of these announcements that comes across the board, Greenland, all of a sudden Greenland's on the front burner. You're looking at Greenland, you're looking at Venezuela, you're talking Iran. It all messes the commodity markets up in a big, big way. So you definitely want to do that. Let me see. If you out, no big deal, no blaming, no drama. No, I mean, we had to get out on that. You couldn't, in my view, you can't stand there. If you're still in there, best of luck to you. But I have no desire to be in there anymore. Let's see. Eyes. I tried riding the wave on the Dow Jones and got stopped out. It was my fault, though. I was too greedy. I was up 20% and just wanted a little bit more. Ouch. Hey, it's Friday. Absolutely universal welcome. All right, one more question, then we're going to get on with the no donation, and then we'll talk about the US 100 first, and then we'll go no donation. Lebo, good to see you, Lebo. What are your thoughts on trading Heikin-Ashi candles? People say that it makes price action much easier than normal Japanese candles, and that people ride trends a whole lot longer. Your thoughts? I'm not a pro with Heikin-Ashi candles. To be honest with you, I made the transition to candlesticks, Japanese candlesticks, to do these live streams. I was brought in on OHLC bar charts. I looked at bar charts for years and years and years because that is really all I cared about. I just wanted to know where the open and the close and the high and the low were. That was it. I didn't care about all the different patterns that we see in candlesticks, but over the years, I've really got accustomed to candlesticks, and I wouldn't go back. I just am not up to speed. Couple of rules on this live stream. If I don't know, I'm not going to sit here and BS you, Lebo. I just don't know much about Heikin-Ashis. I've never felt the use to use them. I've never felt the need to use them. So that's the honest answer. I could try to BS you and give you, I'm not going to do that. I just don't know much about them. I have put them on a chart. I think we made a video a while back on them. I'm not even close to being well-versed enough to give you any legitimate advice. Your expectations for the CAD yen. Yeah, we'll go ahead and cover that in here in just a little bit. I do want to cover the US 100, though, because this is a big one. US 100, definitely a bullish type of a pattern here in your monthly chart, no question. We're getting the compression. We didn't quite get the pullback to 25 even. The low right there this month is 25.81. So we're still watching relatively closely. 25.5 is a big deal. We're sort of rotating there now. I'm still looking at that all-time high, potentially get that runner up over that all-time high, and then we're running towards 27.5. So I'm still very bullish here for the US 100, but there's no question about it. We are definitely taking a break. Definitely taking a break there. Okay, and then we need to look at metals here over on our switch markets, our MT5 platform. This chart, this is a weekly chart. It's not the daily that I've been showing you. I'll go ahead and cover gold and silver towards the end of the stream. Big time pullback in silver right now. That's why your margins are at 2% instead of 0.2% over at Switch. So be very careful there. One thing that I did want to point out on this platform, this MT5, is on your, let's go right here. You'll notice on your mail section, you just click on mail, the mailbox tab on the bottom. You've got an important notice, margin requirement update. And you'll see right there, dear valued client, please be advised that the margin requirements for silver will be adjusted from 0.2 to 2% in response to prevailing market conditions. So what does that mean? Remember, it's your broker. Your broker reserves a right to adjust margins at any time. And believe me, they don't adjust them unless they absolutely have to. The reason why is the volatility is huge. The volatility in silver right now is something like we've never seen. And when we don't know, what do? If we don't know, we limit our risk. And that's exactly what your brokerage is doing there. Everybody's doing it right now. They've cut the margins, they've raised the margins very high on silver because when you take a position in the silver market right now, you are potentially exposed to a huge swing. And what happens is if a broker has all their clients and they all want to trade silver and they all take a position and it goes against them, the net value of those assets at market just goes through the floor, and then the broker's on the hook for covering the difference. That can't be the case. Margins are adjusted, and that's just all about risk management right there. All about risk management. You should be thinking the same way. You see a market as crazy as silver, I love it. Let's get in and trade it. That's what we want to do, but we've got to watch our tails while we're doing it. We cannot punt money. We can't donate money to the markets just because we're chasing big profits. However, oh boy, the big profits have been there in silver. I mean, take a look at these weekly ranges. You've noticed that the volatility has picked up in gold as well, but nothing like silver. Just an absolutely huge runner. Right now we're printing about 88.61, so 90 is turning out to be a key. That 93 is somewhere that all-time high. I just don't really see any way we don't hit 100. I really don't. We'll close with gold and silver today. I'll show you what levels I'm looking at and potentially a game plan moving forward. So there's a couple of things that we do need to cover today, and one of them is going to be psychology. I think that we're in an interesting situation here going into the third trading week of the year. I think we're in a possibility where the weeks have been good, where the winners have been big and the losers have been small. That's at least been my experience thus far. It's been a great year already, and I'm very excited to keep going. So in order to keep going, we have to recognize momentum when we see it. We've got to see exactly what it's going to take for us to be successful in the long term. Now, if you're brand new to these markets and you're brand new to active trading, I understand pretty much everything you're going through. And that's not me reaching my hand out saying, I understand. I feel your pain. I get it. I'm not Bill Clinton. I'm not going to sit here. I feel your pain because I have over in the past. I probably am not right now. But in the past, I've been there. I know what it's like to just get into the markets and say, okay, I'm going to make money right now today. I've got to make something happen right now today. What's important is that you preserve your momentum and you keep a positive mindset. And the way that I do that is I've adopted there's two ideas that I do day to day. Number one, in my time zone, the market's done. Typically the commodities and the futures go off at like 3:15 or so, somewhere in there. I have the 4 o'clock rule where I'm at. If you're on the East Coast, it's the 6 o'clock rule. 4 o'clock rule means I'm done with everything I just did during the day at 4 o'clock. I've already reevaluated. I've already put it to bed. I'm ready to roll to the next day. And the reason why I do that is because I want closure on a day. I want to learn my lessons, and I want closure, and now we're on to the next session. And the reason why we always want to be in a position to turn the page to the next session is because your best trade's always tomorrow. Your best trade is always next week. The best setup you've ever seen is always right around the bend. There's always more trades. There's always more trades. The only way there's not any more trades is if you lose all your money. Think of it like that. There's so many trades out there to be had. We don't cover even a small fraction of the daily opportunities, and a lot of times we cover a ton of trade ideas and markets and levels. Psychologically, your best trade's always tomorrow. With that in mind, what's it going to take for us to succeed tomorrow? In this case, Monday, next week. Momentum. I want to show up feeling good with a positive mindset, ready to achieve my goals for the week. I want to get that next trade set up and I want to cash in and capitalize on it. In order to do that, I have to be in a mental state where I can execute. And the best thing I can recommend is by keeping momentum moving forward. You need to feel like you're moving forward and getting somewhere with your trading career, or else you're going to be in real trouble trying to stick in this game for any period of time. All right. Enter No Donation Friday. That's what this is all about. It's No Donation Friday today. What is No Donation Friday? It's sort of something that I put together over the years of having really difficult Friday sessions. When I first started, I would typically come out aggressive on Monday, dig a hole, fight my tail off Tuesday, Wednesday, Thursday, and be profitable going into Friday. I did that more times than not. And then on Friday, I'd be sitting there looking at my money saying, okay, did I reach my goal? Some weeks I did reach my goal. Some weeks I didn't. Some weeks weren't as good as others. But the one thing with No Donation Friday, the key concept is being ready to go Monday. I wanted to be in a mindset where I could trade well Monday. And I found that when I gave back profits on Friday, or when I took a positive week and I turned it into a negative week, or if I was up 1,500 and I lost it all on Friday, I went into the weekend mentally destroyed. I found two things happen. Number one, my personal life struggled. I was pretty grouchy all weekend, which isn't fair to everybody around you. They're on the weekends. They got a couple, sometimes they have time off. They want to spend some time with family and friends and whatever. It always helps to be happy when you do that. And the other thing that it hurt for me was it really made me just manic on the weekends. I could not wait for the opening bell on Monday. I couldn't wait. I wanted the bell to open so bad so I could start trading again and get back what I lost and get back on the good foot. And again, that put me in a state of just the cortisol dump and the constant stress and the wanting to get it back and the chasing it all. It really wore me down. So I came up with this, No Donation Friday. Very simple. In the markets, momentum's key. If you have good positive momentum at the end of business every Friday, you're going to be in this game a long time. You're going to be in this game a very long time. A winning week. Here are the rules. Here's how you execute. A winning week. You put 50% of your profits in your pocket. If you made $200 this week, you put $100 in your pocket and you roll on to Monday ahead $100. If you're having a losing week, it gets a little bit tougher, right? The urge for us on a Friday after losing the last 4 days is to try to up our leverage and up our risk so we walk out a winner for the week. It's the wrong thing to do. Essentially, you're chasing losers and you're chasing time. Forget about that. If it's a losing week, if it's a small losing week, trade as usual. It means that you've won some, you've lost some, you're not getting killed. It's not a bad way to approach Friday. If it's a big losing week, you've got to consider waiting till Monday to trade. And honestly, I would cross out consider. If you're having a big losing week, shut it down. Shut it down because things aren't going well. You're either making mistakes or the markets are chaotic. Whatever you're doing is not working if you've sat here Monday through Thursday and you're having a losing week. Whatever you're doing, it's not working. Shut it down. Shut it down. Come back Monday, rested and ready to go. Honestly, I mean, pull your charts up, go through your pregame prep or whatever you do to get prepped in the morning. But I don't recommend that you sit there on a demo account and just sit there and rack up a bunch of money to build your confidence, because what it's going to do is it's going to frustrate you. Don't do that. Every time I've done it, it's been a negative for me. Demo accounts have a great, hey, listen, I recommend trading as much demo as you possibly can. But when you're trading real money and you've just had a big negative week and you say, okay, I'm not trading real money today, I'm going to slow down and go to demo and I'm going to trade Friday, I guarantee you're going to win. And that's frustrating. That can be frustrating for people. Now, if you think it's going to build your confidence and get you ready to go, I say get away from all of it and rest. Take the day off. Do your pregame prep. Look at the markets. Read the news. Check out your key levels, and then rack them. Hit the gym. Go. Take an early weekend. Realistically. Lastly is neutral. If you're at scratch, if you're at zero, you can trade as usual. Maybe you've had, I had a bunch of good trades, and then I made a bad mistake, and that cost me some money. So now I've got to fight back out of the hole and just execute. I don't mind that as a scratch day. I say, okay, get in there and trade. Probably the best thing to do is reduce leverage trading. Reduce your leverage. Okay, you won some, you lost some. Let's cut my leverage down because I do not want to go into a deep hole for the week based on a bad Friday session. Cut your leverage down. Say, I'm going to get in here and I'm going to make some trades. We're going to make a few trades and see how it goes. I don't have a problem with that. Cut your leverage down, take a position, see what happens. That way, if you lose, you're not buried. Neutral. Don't trade. It's not a bad way to do business either. Don't trade. Take it off. If you're physically tired or fatigued on a Friday, take it off. Take the day off. Come back Monday ready to go. You will make more money fresh on a Monday and a Tuesday and a Wednesday than you will tired on a Friday. I guarantee it. I absolutely guarantee it. So that's a good look at No Donation Friday. If you're up 500, put 250 in your pocket. If you're down 500, maybe test the waters with some small trades. Probably just take the week or take the day off, come back Monday. And if you're neutral, if you're at zero, you can do pretty much whatever you want. I recommend reduced leverage trading. That's what I said. All right, let me see. Eyes hazy. I wish I heard of this yesterday. You heard of it now, Eyes. When you roll into next Friday and you've got that wad of money in your pocket, remember, pay yourself for your time. Absolutely pay yourself for your time. Critical. Absolutely critical that we understand exactly what that means. It means taking profits, not necessarily on a given trade, but at a point in your trading career. If you guys come out and absolutely crush it in Q1 and somebody's up 30, 40, 50,000, I would say, well, you got a couple options. You could stay with it, or maybe you could take some of that money off the table. I would say probably put 25 grand of it in your pocket. Pay yourself for your time. Pay yourself for your time. All right, we got another trade update right here. Trump speaks at the FX volatility, spikes FX volatility, key level in play for the U.S. dollar Swiss franc. It's exactly what's happening here. We've got a level that's coming up probably for the rest of January. You need to take a look at, have it marked on your charts. 13-month EMA is right up there, right around 82.15. We're looking potentially maybe to short that area if we do get a break. I don't believe the dollar's going to go that high. I really don't. But if it does, we're going to be waiting there. I think this is a pretty good chart to watch for Q1. We're going to get a move. The Swissy hasn't done really anything for the past, 6, 7, 8 months. We're going to have an opportunity to trade it. We just got to get a little bit of action to the top side and get in there and take the short. I'm still bearish on this commodity, this FX pair, no question. But right now, we've got to wait for price to do something before we can trade it. Let me see. We got the CAD yen, and then we got a question from Ralph H. I'll cover that in just a second, Ralph. Great question, too, by the way. CAD yen, everybody loves the yen, right? Okay, this is beautiful. I love this already. This one right here is probably one we should have on our daily radar. I don't typically look at the CAD yen, to be honest with you, but it's not bad. It's probably a pretty good place to go for some money. You've only got about a 2-pip spread there, so that's not too shabby, really. Okay, so something like this, initial read, that's what I would be looking at. Monthly chart pullback zone right down around 111.25. That's pretty robust downside support. So let's go ahead and take a look at what's happening in the markets right now. Weekly. Interesting. Okay. Sort of there would be where I would begin my Fibonacci's down in November's low. Sort of a spike low there. That's what I would call that. There's your low. There's sort of your top, your upper extreme right there. You sort of peeked your head up above 2025's highs and failed. That's called the failed auction. So right now, being bearish probably isn't a bad idea on short time frames just because you do have that failed auction setting up. For me, I wouldn't go really any lower than this, though. A daily chart, we're likely to get sort of chopped up if we try to sell based on this Fibonacci, based on this candle formation over the past 4 weeks. Essentially, this is what you have. You've got heavy rotation. These are very, very tight. Peeked your head up, failed auction, bidders got smashed. Now we're coming back down. We sort of got a doji or maybe even a hammer setting up there. 38% right down here at 112.25 is a pretty good one. What I will be interested in for next week is sort of the proximity of that 13-week EMA towards the 38% level. So right there, 111.97, maybe 112 and 112.25. I could really view that area right there is being pretty darn good downside support. Right now we're printing about 113.59, so we're a ways off of it. I mean, we're about 125 pips, but it could happen. It could happen, and if it does, we've been waiting for the yen to go hawkish for a while now. If this does develop and we do get the reversal, then potentially that could be just a fantastic zone to be bidding the CAD yen. So that's what I would be looking at. Now, as far as you're going to see exactly what I mean, going to shorter time frames, you don't want to do this. You don't really want to do this. It's very. I know it looks attractive. It really does. Spike low, spike high, pull back here. The problem is this zone is very tight, 114.68 to 113. So about 168 pips over about 4 weeks there, 3 weeks. Be very careful with that. If you wanted to bid, if you wanted to be a net bidder and try to get in on, sort of some bullish price action here, you can see that we had some pretty good little scalp right there. Not much money. 62%. I mean, if you wanted to go long and hold it right now, you probably could, but that really exposes you to that systemic risk that I talked about earlier. If you hold this position, you're going to have a ways to go to get paid. And given the CAD and U.S. the state of WTI oil and natural gas right now, going into a weekend news cycle, if we haven't learned anything about the Trump administration, is when they launch military operations, it's on the weekend. So I would be very, very careful doing anything with this over the weekend. This will be a pair that we can revisit next week, though, with a really firm read on what's happening geopolitically. But this down in here, if you get an opportunity, 112.29, 112.30, that's not bad. That's not bad at all there. So I'd be looking at that definitely. Let's see. We've got a few questions here. We got a few questions here to answer. All right. The first question here was from Ralph H. over in the How to Trade community. Good to see you, Ralph. What's your opinion on scaling in and out of trades? Well, I don't particularly do it anymore. About the only thing that I would do with regards to scaling would be scaling out, meaning I would have multiple profit targets. So let's say I bought or sold. Let's say I sold four. Let's just run a quick example, Ralph, to sort of show you what I mean. Let's say, I'm pulling up my chart here, and I wanted to go with something like WTI crude oil. Okay? All right, let's go intraday. Let's go 30-minute chart. Okay, so this is the front month futures contract, March of 2026. All right, price action's been sort of difficult today. So let's say, right here, I wanted to, let's sell 4. All right, so we'll go to trade. All right, let's go right here to our trading DOM. So let's go 4 contracts, and let's go ahead and short the market. Okay, I'm short 4. Right now, I'm shorting at 4. Now, a couple of things that I would be looking potentially to do. If I was looking for maybe a return back down here, back down into this range, somewhere down in here, bottom daily low, 58. Maybe I think we're going to go down to 59 towards the end of the week, see some bearish price action. If I was going to do that, that would sort of be the ultimate of what I would be looking to do there. So my take profit would be somewhere down in here, right? Well, of course, if the market does move in my favor, I could always scale out. So I would be looking at probably scaling out. I say, okay, I've got multiple contracts here. Let's say I want to lock in, $400 profit. So let's go ahead. Let's scale out of this short right around 55. So let's half our position. So we'll take 2 off at 55. That's going to be $400 profit. And then as far as our 4-banger, we're going to let that other 2 run. So that's essentially what I would be looking to do. That's about all I do anymore, is trying to get in on runners. Now, from a scaling in standpoint, it's something that I would say, okay, the question I would ask myself about if I wanted to scale in, and there's nothing wrong with it. I mean, I've known some traders that scaled in religiously. That's what they did. And the idea here would be, okay, there's my short, right? Now, let's just go ahead and get that order out of here. Okay, so there's my short. Now, a lot of folks would say, okay, maybe if I break this swing low, that's when I know that I'm really going to be in the money here. That's when I know that this market's really going to crater. So what can we really do there? To do that, we would just go to our order, and we would go limit, and we would want to just go sell limit and just take it, right down here beneath our swing low, somewhere right down in here. And that would be the idea when we would add another 4. This thing's filled us out market in any case, or it hasn't been printed yet. Anyways, whatever, just execute it. The bottom line is this: you want to sell, you want to limit, and you want to put, actually, that's going to have to be a stop order, So you're going to sell there, and your price is going to be somewhere right down in here. Sell it. I used the wrong kind of order. It wouldn't be a limit order. It would be a stop or a stop market order. Typically, I use stop limit orders, so it's real tight. In any case, so right there, we would want to sell and add to this position and try to get in on our big runner, that being our confirmation that, yeah, we were correct about the market move. I don't have a problem with doing that. One of the people that I worked with over the years, if you guys have been here, was Nick Quinn. He was big into scaling in. I don't know if he still is, but the way that he traded is he loved the Forex trades, and he would take positions, and then he would add to those positions at different levels to really try to get in on those big moves, and he could do it. He knew how to do it. For me, I've always just sort of been a static trader. Here's my entry. I'm damn sure about my entry. And then here's where I want to get out. I'm going to take a couple off here, and then we're going to play for the runner. That's sort of my views on scaling in and out of trades, Ralph. So my opinion, I like scaling out. There's nothing wrong with, especially if you have the capital to just leave a runner on, because sometimes you get in on those big $2 and $3 moves, and one of those runners is worth so much. But they don't come around very often from my experience. They really don't. As far as scaling in goes, I don't mind it. If you have a strategy for it, great. I don't particularly do it. I don't like it. I don't do it. And the reason why is if I'm already in perfect, I have a problem messing with my entry point. To me, the entry point and the stop loss point are just jobs, 1 and 2. As long as I know that I'm in very good position to make money. With the rest of it, calling big moves, that's sort of a challenge. All right, let's see right here, Lebo. I don't know how to trade Fibonacci. The strategy that works for me is the EMA pullback and RSI. That's great, Lebo. If you don't understand something, don't do it. Your strategy right there. A lot of people would be like, man, that's hard. The EMA plus pullback and RSI. So if you had an EMA, a 9 EMA, say, that's one of our most popular strategies on how to trade on YouTube. So if you had a 9 EMA setup, you could wait and play the pullback off of the 9 EMA, right? Play the pullback long or short, and as long as your RSI conditions are met, then you got a shot. I like it. There's nothing wrong with that. Let me see, Ahmed, what would your stop loss be in that situation with the CAD yen? Well, it's a challenge because you don't really have the trade set up just yet. So this up here, if you went long right now, you could probably play it as a tight scalp, stop yourself out. I don't know, like 44 beneath that 50 handle. And you can see right there, you went down immediately and you hit 50. So your low right there is 113.47, and then you bounce. Let's go to a 1 minute chart. Okay, so it's already been a decent scalp off the 150 zone. Boom, boom, right down there to 47, and you sort of rallied. The high up there was 63. So, I mean, that's 13 pips. I mean, that's a high-impact scalp. That ain't bad. As far as what I would be looking to do here from a macro trading perspective, I think I probably would be laying off of those daily charts. I would be looking for more on the lines of this weekly chart. I really like this weekly market structure. I think it's fantastic. I mean, that right there, that's your uptrend. You can't argue with it. Uptrend, 2-week pullback, failed auction up here. You just move your Fibonacci's up to that top. I would ignore that spike low for right now just because it's sort of choppy, but I would be working this range from November's low or right up there to this year's high. Failed auction up here. We're selling off 112.27. You know, where would your stop loss, where could you put it? You play it a number of different ways. You know, you could be looking to bid maybe 112.30s, maybe 112.35s to be aggressive. Stop yourself out like 111.89, something like that. Give yourself 112 as sort of that last line of defense. You could do that. As far as, you know, using Fibonacci's, what could you do? You could look at taking a position. You do something like this. You know, maybe bidding, looking to bid somewhere up there with your stop loss being beneath the 50% level. That's a lot more risk. I don't really think you need to take that extra 40 pips of risk, but you could. Or you could just put it down here, try to take the position and put it somewhere down in there. You know, I don't believe in that really either. I think that's a tremendous risk for something that if it sells off, I would much rather just trade this level and keep it a little tighter and then trade this level down here if the market really falls apart. That's what I'd be looking at here with regards to this CAD yen. I think it could be pretty good. It's a good one. This is going to be on my radar for next week. Let me see. What about scaling in terms of adding positions on a retracement? This is a good question, Eyes, and this is one that I get a lot. There's a lot of signal providers out there, and I've talked to a lot of traders around. And I'm just going to leave it at a lot. I'm not going to give you guys any hard numbers. And it's sort of anecdotal evidence, but it's still evidence. A lot of signal providers out there are going to give you a signal, a trading signal, and they're going to tell you to buy. Let's run through an example. So right here, and we probably should have just executed this WTI trade. That's funny, isn't it? We threw a short down just because I'm bearish the market, and going into the close, I thought it might sell off, and it is. So, you know, when you're in the market for that long, sometimes you can do things like that. I don't recommend those, though. Those are tough. In any case, okay, so let's say you had a signal provider, and they said, okay, just go ahead and sell the market. Okay, so you sold the market. There's your sell. A lot of times what they'll do is they'll be wrong on their entries. Essentially, there won't be any market follow through. The market will bounce off their entry and take a draw. It happens to all of us. I mean, it happens to you guys trading. It's happened to me countless times where you get in and then the market starts going against you. Well, that's what we have stop losses for. But a lot of these folks won't operate with stop losses. They'll say, okay, well, we sold it down here at 50, 59, 63, so you got to love selling 60s. And you gotta love selling 60 and a quarters, and you gotta love selling 60 50s. So what we'll do here is we'll just take an initial position, and then we'll scale in at these levels. And what that'll do is that'll bring your overall entry point. It'll bring it towards price action because price is going to come back, and eventually we're going to be profitable. I can tell you that can work for a long time. It can work for a long time. You can be doing that for years. But believe me, when you get hit, let's go ahead and just show you on this short what can happen. When you get hit, there's no rules on how high the market can blow against you. No rules. So let's say you buy another 4 there. You buy another 4 there. So now all of a sudden, at some point you're going to be sitting at 60.59. Your entry point, while it's true that we sold, 59, 63s, if we scale in towards the back, you may be able to get your entry point somewhere up here, 60.14. And in your mind, you're thinking, okay, I think the market was going to go down from down here, and now I'm net short from up here. I'm in line to make a lot of money. And you're not necessarily wrong if the market comes back. But eventually, this will happen. That will happen. If you trade like that consistently, it's a foregone conclusion that will happen. You sit there and you say, okay, well, I was short from 59. Okay, I still had a good market read, and then I dollar cost averaged in. That's what it's called, dollar cost averaging. And you're going to be right up, okay, now I moved my entry point. I netted in at about 60 and a quarter. I was in great shape. And then something happens, and then Trump invades Greenland. Or something goes crazy on you, because what you've done is not only have you put more money on the trade, but you've increased the length of time that you're going to be in the market. Now, eventually, if you scale in up there and you say, yeah, but man, our profit target's down here at 55. So, I mean, boy, if this goes down, I'm going to make that much more on my trade because I'm highly leveraged now at a better price. I love it. Yeah, you are. But what else are you? You've increased your risk exponentially. And if this happens up in here, you're probably going to lose everything. You're probably going to blow your account out. But even let's say if price just sort of diddles around right in here and you're sort of not really positive and not really negative, look how far you have to go. Look at what has to happen in this market for you to be a winner. Things have to turn, and they have to turn in a big way. Typically, that means you're going to be in the market longer, and it's going to take some sort of fundamental catalyst to drive price to the promised land, your profit target. I see that happening a lot. I've heard that from several traders. I couldn't believe what I was hearing. And I said, signal providers are doing that, huh? Understand that if they've got you scaling in against bad trades, negative trades, it's a matter of time before you run into the doomsday candle, to the career changer, to the account crusher, to the ledge walker. It's a matter of time. Remember that when you're dollar cost averaging in. Now, to answer your question, you're talking about something a little bit different, Eyes. You're talking about scaling in positions on a retracement. Here's how it's different. Let's say that, okay, let's go here. Let's get rid of all that stuff. Go ahead and close that out. We're just making money hand over fist on these market orders, right? What are we up, $2,000? I love it. Okay, so a daily. Okay, great example. Great wave right here to work with in WTI crude. This is going to be a little bit different. Okay. Let's say we still like the uptrend. This is purely hypothetical and example. I do not believe in this at all. Let's say I like the uptrend in WTI. I can buy some, take an initial position at 38% at 59.70. I love this uptrend. I believe it's going to continue. Is it wrong for me to scale in at 62 and 76? Not necessarily. Not necessarily. Why? Because I know exactly where I have to get out, and that's beneath the 100% section of this wave. So if we're talking Fibonacci's and ranges, it's not a bad idea. It's really not a bad idea because I have a finite out point. Now, our other example where these guys just have you selling into the market willy-nilly trying to improve, all you're trying to do is figure out when you're just waiting for the market to turn. You are truly gambling. This is a little bit different because I can dial in my risk 1% to 3% on a trade. Okay, if I'm going to risk a max of 3% on this wave and on this range, all right, let's grab some here. Let's grab a third. Let's grab 1% here, 1% here, 1% here. That's almost going to guarantee that I get probably not necessarily the best price point, but I'm going to improve my price point above just buying everything at 38%. And if I know where I have to get out, period, if I know where I have to exit stage left on this trade, then it's not a bad idea. I know I have to get out under 55.62, so then it just becomes a math problem. So I'm saying, okay, let's buy some here, let's buy some here, and buy some here. We've got a trade. I can manage my risk that way. I'm not going to lose all my money. I know where I have to get out. A couple of things to remember when you're scaling in. This is textbook. This is what I would call responsible dollar cost averaging. But this is a textbook example of you get into the money management in the deep end so fast, and it becomes so hard to quantify your performance. Okay, fine. I buy two here at 38%. Price goes up and hits my profit target. It's a winner, right? Okay. We would have made more money if we got a deeper retracement, right? And maybe the next trade, okay, I buy that, and then I buy that, and I buy that, and then the price stops me out. So there's a pretty good chance that I'm going to run a net negative if I just don't win those deep retracement trades. My success is going to depend on those deep retracement trades. So remember, I mean, if you're scaling in against a losing position, the odds of you losing go up. The market's moving against you in a big, big way. Remember that for scaling in. Your odds of success go down. Now, here's an idea that I've done over the years, and we're getting into some pretty advanced stuff. So if you're a beginner, I do apologize. I call it an invisible trade. And this is where, well, it's a lot of folks call it trading the middle. A lot of the big Wall Street guys going, oh, I trade the middles. I'm the middles. I call it being invisible because they don't know where I am. The market really genuinely does not know where I am. You've got a range here, trade in the middle, essentially. I would wait, maybe buy somewhere right in here. Maybe buy a 62% or a 78% and look for that bounce. If I do that, I'm capitalizing on the inside of the market. Now, if I'm buying up here, if I'm buying up above this weekly high, the whole world can see me. They know exactly what's happening. Computers go off, alerts go off all around the world going up. Crude oil's pushing daily highs. Crude oil's pushing weekly highs. Crude oil is establishing new yearly highs or new monthly highs. They know you're up there, and you're either going to win that fight or you're going to lose it. The market's either going to blow in your direction or it's going to reverse in your face. That's called being naked up there. You are obvious to everybody. Everybody in the world can see you. People with more money, people with less money. If the people at CNBC can see you, then you're pretty vulnerable up there. Now, you can scalp the edges. You can play the extremes. I don't have a problem with that. Just keep your profit targets realistic and have a quick trigger if the market blows up in your face. Everybody can see you at the extremes of these ranges. Everybody knows where you're at yesterday's highs and lows. If you're buying there, if you're selling there, they can see you. Where they can't see you is in the middle of those ranges. So that's why a lot of traders, what they do is they call it trading the middle. So as price rises, maybe up towards this upper extreme, they're selling here. As price falls towards this lower extreme, they're buying down here. If price is in the middle and it's very compressed like this, they're just buying and playing ranges inside of your established trend. It can be very good. It just takes a different mindset to really do it successfully. Well, we're already in the tall grass. Let's just go ahead and talk about it. Let's see. So this would be sort of it. Something like this. These would be your time price offering charts, TPO charts. I've talked about this a lot. This sort of would be where, and that's a daily chart, so it's not going to give us a good read on it, but this would be how a lot of commodity traders, a lot of futures traders play it. This is market profile. This is what I was taught. You'll notice that I don't talk about it much because it's hard. This right here, initially, the first thing that would have been shown to me, my uncle would have sat there in front of this chart, and he would have looked at it. He says, that's a B formation. I go, what's a B? He goes, it's a B. I go, capital letter B, huh? He goes, yeah, volume here. We're going to fill this in. So going into the late session, he knows the point of control right here. That's where we've been trading forever. That's where the action is. That's where price is right now. He would say, okay, from the point of control, where do I think we're gonna trade to? And he would be shading that area in right there. That would be what we call a B formation. That's the void. That's a textbook B too, by the way. That's a textbook B, and that's what you'd be looking for over the past 24 hours. This session's profile. Pretty good trade. So he would be saying, okay, point of control's here. I'm going to look for maybe a breakout and a fill-in right down here. So he would probably be from here looking at 59.66, trading down to maybe 59.50 in that 8 to 10 to 15 ticks. He would have enough leverage on it to walk away from the day, probably making a lot of money. So that's sort of what we're talking about by trading the middle. That's invisible. Nobody can see you in there. Look at all the business that's been done in that price range. Your orders are going to look just like everybody else. However, if you're sitting here saying, okay, I want to trade the extremes, I'm going to be a hero, this market's going to jam and run. Everybody can see you above that A period high, and I mean everybody. So something to think about there if you're an active trader that's interested in different strategies. Scaling in is a big part of trading the middle. And as long as you have a finite out, you can do it. You really can do it. Okay, everybody. God, we got into the tall grass today talking strategy. I hope you enjoyed it. I get a lot of questions about the time price offering and the market profiles and things. And boy, I mean, yeah, we've just scratched the surface of trading over the past 4 years in here. Just the moving averages or the Fibonacci's, those are things that are battle tested for me that I know are fairly easy to comprehend. And you don't have to have 20 years of experience of reading market profile to understand, what it is. You don't. It's very simple to do horizontal support and resistance levels. What we're talking about right now, when I bring up that B formation, not only do you have to have a good trade idea, but you also have to have the follow through on that trade. And typically the traders that are going to take that late day short going into Friday's close are going to be looking for that thing to fill in here in the next 20 minutes. Going into the finite close at 2:30 p.m. Eastern, you're going to run into real trouble there because it's going to be a rush. It's going to be a rush of participation. Everybody's going to be trying to square their books up ahead of basically going to the bar later or going out to dinner. And that's what you don't want to get caught up in. Those chaotic, crazy times in the market. You don't want that. Okay, let's see if there's any more questions. If not, we covered scaling in and scaling out. If you guys are interested in doing it, do it. If it makes money, it's the right answer. I'm never going to sit around and say, you can't dollar cost average it. And then you go, what are you talking about? I'm up 10 grand last month. And I go, keep doing it. Keep doing it. I mean, if you're hitting a home run every other day, I mean, keep hitting home runs. I don't know what to tell you. Just because no one else can hit home runs doesn't mean you can't. All right, let's see. Take us into the weeds, Steven said. Steven, we got into the weeds today. Let's see, Lebo, how come my broker won't allow me to execute trades on U.S. pairs when a news event happens? Has to do with the margins, Lebo. So what you're seeing there is those spreads go crazy, the markets go crazy when you get that big economic event. And what happens is the participation makes the markets chaotic. That increases the chance of crazy volatility. And if they let everybody get their trades down during those news events, essentially the broker has to cover the liability. So like, let's say you have $2,000 in your trading account and you go in and you're long Euro USD, right? You're long Euro USD. Well, everybody else in the book's long Euro USD too. And then Trump comes out and says, well, I'm going to go ahead and change my nomination for the Fed chair. And the market goes absolutely crazy. Or no, this would be NFP, excuse me. So let's say NFP comes in. Everybody's long the Euro USD. NFP comes in stronger than expected. The USD just absolutely crashes. What do we have there? Or it comes in weaker, whatever. Market crashes. Then the broker's on the hook for covering all your losses. That can bury a brokerage. It happens a lot. That's why the brokers, they bring the leverage way down. They increase the margin requirements, bringing your applied leverage down, or they just don't let you trade it at all. It's not necessarily a bad thing to do. You're not alone. I get the emails before every economic news events from my brokers. They all say we're adjusting the margins, or they're shutting the trade down completely. Interesting stuff. Okay, Ahmed, you just open the doors of volume profile. Be ready to receive all these questions. Yeah, I get approached quite a bit on how do you read volume? How do you read market profile? How do you read volume? And I go, yeah, how much time you got? It takes a lot of practice and a lot of experience. Like right now, let's look at our chart. I mean, look at all that stuff. It all means something. It's all ugly as sin. Look at it. Look at this. Our B formation. Boom, boom. Point of control is holding up right now as we roll into that 2 p.m. hour. Basically, the last 30 minutes of trade. You need to get this move. You need this price to close beneath the point of control to even give you an opportunity to make a play here, realistically. This right here. Let's see where it closes. We only got about 35 seconds left in this 30-minute price bar, but this would be the time frame you would use. It would be a 30-minute. Let's get rid of all the drawings. We don't need them. So there's your B. A lot of bidding down here, sort of a value area, right? Your volume is heavily right in this area. Point of control, never forget where the point of control is if you're trading volume. That's where all the business has been done today in crude oil, right around 59.75. This time of day, a lot of people would believe that's probably where price is going to settle. Just depends. I know that if I take a short right now, I could stop myself out right up here, potentially get that move late in the day. That's what you would be looking for. That would be a day trade. Well, it wouldn't be a day trade. It would be a real short-term position. Will it work? Well, you'll notice it's not an accident that close is right on the point of control. That's where the business has been done. The buyers or the sellers can't shake you from that area. So, if you're taking a short, great. If you're taking a long, great. I'm partial to the short side of this market. I've been outspoken about that. I probably would be holding shorts right here, and my target would be very, very simple. We haven't done much business at all. This is what we would call the weak part of the chain. The chain gets weak. That means there's no real volume here. Price discovery is all about buyers and sellers hooking up and butting heads at a level, agreeing that, okay, and then people coming in saying, okay, that's not the price anymore, and then moving to another value area and filling it in. This area right here has been neglected throughout the last 24 hours, or going back to our 4 p.m. open, 4:15 open, whatever it is, right in there. So this area would be suspect in my view. I would be looking for that market. If we're going to get a move, and nothing has to move this market, if you're going to get a move, I would think it's going to go down around 49.50. That would be my guess. Now, I'm not saying that that's going to happen, but what I do know is if we just take the trade, right? If we just go ahead and say sell market, okay, there's our 4-banger. I know exactly where I have to get out of this market at. Stop loss is going to be right up above what we call, this would be J period. So I would have my stop loss right up above J period. We're in K period right now. My take profit would be probably somewhere down in here. Now, are you really going to get a runner down to 31? No, you won't. But you may be able to test that chain, maybe somewhere right in there, 45. So you can see I'm almost rocking a 1-3 risk versus reward. How about let's get even more conservative? Let's test the bottom of this range just north of maybe 50, 55. Okay, that's a 1-2 intraday trade. Going into the close, it's high risk, but our volume analysis does support it. We're right at the point of control. We've got an overall bearish bias. The market is up today, so we are fighting a bit of a trend, but it was established during the London session. Could we fill in this void in this chain down here? Absolutely. Absolutely. Will the trade work? I don't know. I have no idea if we're going to get the follow through. What I do know is where I have to get out of the market, and that's only about a 10-tick risk, something like that. What's K or J period's high? 59.84. So let's go ahead and put that right up there, right around 86. We'll pad that 2 ticks, and you can see you got about a 1-2 trade. It's a little bit, that's sort of a look behind the curtain of what I'm doing every day. All right, everybody, I'm going to go ahead and sign off. We have one last question here, and then I'm going to go sign off. We've been going over an hour, which is my pleasure. I'd love to answer the questions, anything you guys want to go over. Let me see, Lebo. My mom and dad think that trading is gambling. Is there anything I can tell them or anything you can tell me to convince them it's not? Well, I mean, as far as gambling goes, I mean, it's a form of risk-taking and speculation. The difference between this and gambling is you can control how much you put at risk, and you can control what you do when these positions go in your favor and go against you. I talked a lot about gambling, I believe, about a week ago to open the year, and I always said, listen, a gambling game is one that has negative expectations. So if you're playing blackjack, you are operating at a negative. The house has anywhere between 0.5% and a 1% edge. You can flip that in your favor trading. That goes through strategy and your risk management. Now, the only thing that's really going to tell the tale is over time is if you can show profits consistently. That's the bottom line. If you can keep your emotions and not chase and not over leverage and do all the things that undo us as traders and establish that edge, then you have the edge. I would say, is the casino in the business of gambling? No. What you're trying to do with your trading career is become the casino. You're trying to operate with a net edge and an advantage. That's what you're trying to do. You're not going into one trade saying, okay, here's all of my money. Here's my birthday money, and we're going to try to make $1,000 on it. If it works out, great. If not, great. That's gambling. Betting on a football game, taking Indiana, laying the 8.5 points against against Miami, that's gambling. It is. There's no question about it. Trading's risk-taking. Manage your risk, though. Get good at setting stop losses. Get good at not chasing. Take a lot of pride in having discipline. That's when it's not gambling anymore. You have no control over what happens on any given second, but you do have control of when you can get out of the market. That's up to you. And because of that control, that makes you the casino. That really does. So think about that. You're in control, complete control. What do you mean? The markets go against me. Yeah, but you control how long you're there. When you go to a casino and you pull a slot machine, you put the $5 in the hole and you pull the handle, you are in no control. The reels are either going to line up and spit out a bunch of cash or they're not. You have no control over that. None. But in the markets, I know exactly what I'm doing. Look at this. I know exactly what I'm doing. Right now, I'm up on this trade. I'm looking exactly for where this thing should fill into. I'm looking for 55. We're printing 68s right now. That's where I want the market to go. I know where I'm getting out if it goes in my favor, and I know where I'm getting out if this thing blows up in my face. This dollar amount right here is always affordable. As long as you make sure that's affordable, your good risk management principle, you're not going to run into trouble. You're going to be in the game a long time. That's the difference. That right there is the difference. You're becoming the casino. You're not going to the casino. You're not taking the free drinks and the free dinners and the free shows. You are the casino. That's it. That's what I'd tell them. I've heard it all. Believe me, Lebo, I heard it all from everybody. You just want to sit there and gamble all day. I said, well, there's money in it. And as soon as you show the money over a period of time, they go, oh, well, I guess there's money in it. Last thing I'll say about it today, this has been a good psychology session, is the concept of risk. This is a job where you can go to work and do everything properly and still lose money. Now, your parents, your mom, your dad, maybe your significant other, girlfriend, wife, spouse, husband, boyfriend, whatever, they may go to work every single day, work 8 hours and say, okay, I made $200 today. And they'd look at you and say, Shane, you went to work today and you lost money. I'd say, yeah, sucks, right? But what doesn't suck is on those days where instead of just making that static 200, you make 2,000. And then it's a situation of, man, what can you teach me how to trade? That's really how this game works, guys. And your success really is up to you. We can help you. I can help you as much as I can. I mean, we can put market analysis and do live streams in our newsletter. Be sure to check out the newsletter. But all in all, it's going to boil down to you. What you do with your time in this market, what you do with your psychology, what you do with your trades. I mean, look at this. I got a 1-to-1 winner going. That B formation is going to fill in. It looks absolutely fantastic. The market is coming my way to my trade. We did that live. We did that on the fly. I didn't have that pre-planned. I don't know which way the market's going to go right now. I have a profit target and a stop loss. We showed you every step of the way. I showed you my thinking, what we're doing, how we're going to get the money, and what we're going to have to accomplish for this to be a winner. We did it all in real time. What does that mean? It means I have no control over what the market's going to do. I don't know if it's going to break down or break up, but I know what I'm going to do right now. And as long as I know what I'm going to do, I've got a chance. And that's what makes it not gambling, in my opinion. That's something to think about there. Like right now, the question for me, live trading, if this is a real money account and I'm live, I'm going, okay, I've already got my move. I'm up about $500 on the day. Do I want to stick out and wait for that 800? Do I want to move my stop loss to break even? What do I want to do? How do I want to execute? What do I want to do? Am I still gambling right now? No, I'm in complete control. I know exactly what I'm going to do. I'm saying, okay, I can let it go. I can cut it off. What am I going to do? You guys know me. We're going to take the money and run in the week with a winner. All right, everybody, you guys have a fantastic trading day. Finish up strong. Don't give anything back towards the end of this session. It's No Donation Friday. Be ready Monday. Monday's going to be an absolute light show. We're going to have a lot of fun really breaking down the events over the weekend. One last thing we need to cover. I forgot because we started trading. Trump Insurrection Act. This is very much on the table if Trump does declare the Insurrection Act and send the U.S. military into Minneapolis, among other cities. You're going to see a market move on Monday. It will be almost an unprecedented event. Last time it was done was 1992. That will shake up markets. It'll be an interesting firestorm. The reason why the markets will move is because typically when you send in troops to an area like that, it's not good for your political business. It's not good for business. This is an election year. You're looking at the U.S. midterms here this fall. Could the Insurrection Act play a big role in the U.S. midterms? You bet. You absolutely bet. All right, guys, I'm out. Wow, 59.60. We should have stayed in that trade. Have a fantastic weekend, a great trading day. If you have any questions, head on over to How to Trade. Send me a private message. I'll be sure to hit you up. All right, that's a wrap for this week. Have a great weekend, fantastic trading day. And as always, trade the action well, and we'll talk soon. See ya.